Hey guys, Mark from Mark Melbourne here. So in this video, I wanted to go over a couple of reasons why, if you're considering buying stocks right now, you should reconsider. And I'm not saying it's a bad time to buy, but I want to give you guys the other side or the other opinion as to why you might want to hold off at the moment. So one of the reasons why I've been prompted to make this video is I'm somewhat alarmed by the amount of people that are asking, or first time investors that are now asking, what stocks should I buy? And also, even people from work and just people who are generally around me, I feel the vibe is a lot of people are looking to buy stocks for the first time, and the recent dip or recovery has made a lot of people consider buying stocks for the first time, especially when they see a 10% or 20% increase in one day. So a perfect example of this is Commonwealth shares went up 11% yesterday, and if you bought the day before, you'd be up a bit of coin right now, right? So what I want you guys to think about is what's actually happening at the moment. So in terms of the economy, 5 weeks ago, we were at all-time highs. We had crazy lofty valuations for a bunch of companies, including Afterpay, including, there's too many to list, but overall the whole market was overvalued, and and the reason why it was propped up so high was just sheer greed, right, in the share market. Now, if you believe that we're going through a recession at the moment, which is defined as 2 periods or 2 quarters of negative growth, then there's a good chance that, what do we have to reference? We've got the global financial crisis in Australia in 2007, 2008, and then we've got the 1987 recession as well, right? These recessions from top to bottom on average took about 14 to 17 months. So while we sit here, 6 weeks from, or 5 or 6 weeks from all-time highs, we've had our first retrace shore down to about 40%, and we're getting what's often people refer to as a dead cat bounce or a relief rally, right? So this is just this is on the back of $130 billion stimulus or wage subsidy, which government has pledged will help keep 6 million jobs. But that doesn't change the fact that we've got a pandemic that's going on at the moment. Although yes, numbers do look like they're improving in terms of infection rate, it's far from recovery, right? And once this health crisis passes over, we're going to have an economic crisis that comes on the back of it. Just think about all the layoffs that's happening at the moment. Think about all the people that were in secure jobs, retail, shopping centers, gift stores, everything, including massage places, beauty salons, all these small and medium businesses that make up the backbone of Australia. A lot of these businesses have been told to shut their doors for at least 1 month, and we don't know whether there's going to be a period of 3 or 4 months of quarantine, and then back to business, and then a second phase of quarantine, right? So what does this mean? This means that physically output is going to be lower during these periods. Physically, during recessions, people, unemployment rates go through the roof. More people are applying for jobs or job seeker through, government handouts, social payments to get them by. And, this is going to potentially last, if history is any, gives us any suggestions as to what can happen in the future, although it's not guaranteed, if this is a recession, this could take at the very least 12 months. So if you're in a position where you've got some cash, that's really awesome, right? And if you want to invest that money, well, how will you feel if you put that lump sum of money and you see prices fall from 50%? And yes, right now it might be easy to say that you're investing long term and that they're only going to be paper losses, which is true, but paper losses of 50% is going to be difficult to handle or stomach anyway. So think about what happens during a recession, right? So people lose jobs, there's lower output, there's high levels of alienation, multiplied by the fact that we're indoors at the moment. We're indoors because of the pandemic, because of the virus. And with that being said, mental problems, mental health related problems, physical related health problems are going to increase, and we're going to see, lower levels of output. So during a recession, when people have less disposable incomes, you find more issues in crime. You see more issues specifically with, like higher levels of domestic violence. And statistic tells us that with less disposable incomes, people turn to inferior products. During this period when people are indoors, you can bet people are going to be turning to online streaming and cheap online entertainment services. So if you're a business and you're adapting, you're offering your services online, you're rethinking your tone and your creatives, and providing value up front, you're going to have a chance at winning, right? But the harsh reality is big companies like Virgin are looking to be bailed out by the government. And if they do get bailed out by our government, then that means Qantas is going to ask for 3 times the amount of what Virgin is going to ask. So what does this all mean? It means that we are using monetary policy, we are using quantitative easing, we're printing money. The US has been printing $6 trillion, I should say, of which $2 million is meant to go to each household. It's been recently announced that $500 billion, so a quarter of that is going towards surveillance and technology to understand people's movement and patterns so that they contain the virus better. So that's going towards, security and surveillance. It's not going to each household. And, with 3.3 million people applying for unemployment in the US, this is a record high, and this is for 1 week, right? That represents 1% of the population of a total of 330 million people. So think about how many people are applying for unemployment at the moment, whether we think we're different in Australia, whether you think that the $130 billion is going to be enough to save a lot of jobs. A lot of people have already lost their jobs, and we don't have a defined or definitive, solution or vaccine or date that businesses are going to be operating back to normal. And even when businesses get back to normal, it's going to take the economy a while before they get back on their feet, and for businesses to find their way of making their cash flows, return back to a normal steady stream. A lot of businesses have already closed their doors, created a lot of layoffs. Businesses with a lot of cash reserves, they can invest in their people, they can invest in training and technology at this time and come out ahead. But other businesses with less luxuries, they have to focus on either cutting back hours, offering leave without pay, or pay with absence, and then they can also look at reducing salaries as another option. So what I would recommend, if you're a long-term investor, and this is not financial advice, obviously you can do whatever you want with your money, and you can follow whatever advice you hear out there, but my recommendation is to move slower, to look at potentially investing with the time frame, with the discipline of investing over a long period of time, over periodically, strategically buying every month for a long period of time, and don't rush into it. So what does that look like then? So if you've got 25 years ahead of you where you don't plan on taking that money out, even though shares are liquid and what you feel today is not necessarily what you're going to feel in 5 years, if you have the discipline and you know that you're not going to take out that money, why does it matter if you buy this month, next month, the end of the year, or the start of next year once prices are a little bit higher? What I would recommend is looking at buying over a period of 12 months initially to establish the habit. If you haven't bought shares before, look at ETFs such as Vanguard, where often they'll offer a basket of stocks, right? ETFs. And if you look into this, do your research, look into VAS, Vanguard, VGS, which gives you international exposure. AFI is another one that basically tracks the ASX 200. These ETFs is essentially a basket of stocks in the ASX 200. You limit your exposure to any one particular company which may not weather the recession, and it exposes you less. There's less strategy involved in it. You can then focus on creating the discipline, creating the habit as if you're working and creating a new routine, health routine or other habit, until you get a feel for the markets. So if you're watching this video, there's a good chance you probably belong in that camp of someone who has recently invested, or potentially you're looking to invest for the first time. So what I would recommend is look at your total salary, right? If you're making X amount of income, if you know after all your expenses, after all your holidays, after all your rewards, you know you're happy to invest 10% of your income or 20% of your income, depending on your situation. This will vary. You can use that amount to periodically to buy, and you can use plenty of brokerage options, including Commonwealth, South Wealth, which is cheaper brokerage but has a simpler platform. These both companies have CHESS holdings, which means you own the shares, and there's also stake for US stocks. So consider these options, but what I would recommend, if you're a first time investor, seriously consider ETFs such as Vanguard, which has low fees. They pay a nice dividend, which you can set up a dividend automatic reinvestment plan, which means that every quarter when there's a dividend paid out, you can use that to reinvest back into the stock and purchase more of that stock. So that's my advice. I wanted to sort of go more into detail about recessions, but I know this channel focuses on stocks, so there's a lot of other channels out there that cover the economic side of things and the monetary policy side of things, and there's plenty of articles out there, so I'll just touch on that briefly. Anyway guys, if you like this video, make sure you give it a thumbs up. If you have any differing opinions, if you're looking to buy because you think, there's a 20 or 30% discount is always a good time, insert Warren Buffett, buy the blood, quote here. Let me know. I'm curious to know what you guys are looking to do if you're in a position to invest. And also, if you are, share your age, share what your plan is for investing, because I think when I make these videos, I realize that obviously at a different age you've got a different investment strategy, where you've got the luxury of potentially being able to invest a little bit more aggressively when you're younger, in your late teens or in your early 20s. Anyway guys, thanks for watching, thanks for tuning in. Stay safe out there, keep your hygiene well, and make sure you stay physically, mentally and emotionally fit during this time. Look after yourselves and peace out. Bye.